Today we're talking about risks affecting your retirement and how to fix them. And I bet some of them you haven't even thought about, so stay tuned. So when people think about risk, they're usually thinking about one thing: stock market risk. That's the risk they're focused on. That's the one they want to find a way to fix. Well, today we're going to go over a list of several others that are just as important. But let's start off with stock market risk. So the fancy terms for it are systematic or unsystematic risk, but it's basically the risk that you're going to lose money in the stock market. The stock market goes down, you lose a bunch of money. That's the risk. And so what a lot of people do is they make allocation changes. They take some aggressive money and they move a bunch of it to be safer, trying to get rid of that risk. But remember, every decision has unintended consequences. We're going to talk about some other risks that come up. So when you move your money from the stock market to safety, you are now introducing interest rate risk, inflation risk, longevity risk. There's other risks that you're bringing into the fold here because you made that one move. So we need to think this through. There are ways to handle each of these risks without negatively affecting the other risks. So the next risk is tax rate risk. So let's look at this slide. You see here, 75% of your traditional balance, let's just say, is yours, and 25% is set aside for taxes. This is just assuming that you're in like a 20% tax bracket, 5% state, you're paying 25% taxes. That means 75% of the balance is yours, 25% of the balance is the IRS's, you're just holding it for them. So what is tax rate risk? It's the risk that taxes change and it negatively affects you. Let's say tax rates go up and now you're not paying 25%, you're going to be paying 35%. That means the 75% that was yours is now down to 65%. So let's put some numbers on it. Let's say you've got $1 million TSP balance, $1 million IRA balance. Of the $1 million in the 25% tax bracket, you really have $750,000. You're holding $250,000 for the government. And let's say the tax rates change. You're not holding $750,000 anymore. It's dropped from 75% to 65%. You've got $650,000, and now the tax portion went from $250,000 to $350,000. You've lost $100,000 just because the taxes changed. That's tax rate risk. Now, can this risk affect your retirement? Well, you bet it can. Let's say you retire at 60 and you're going to live to age 95. You got 35 years there. Do you think there's a chance that the taxes may get worse over that 35 years? I think so. I mean, now nobody knows for sure, but most people I talk to say, yeah, over 35 years, I think the taxes are going to get worse. So that means there is tax rate risk affecting your retirement, and most people hadn't really thought much about it. So how do you fix it? You want to move some of your traditional money over to Roth at a tax rate that you like and get rid of the taxes. The more you get rid of taxes, the less tax rate risk you have. So the fancy term is called a Roth conversion. Taking traditional money, moving it to Roth is a Roth conversion. The TSP doesn't let you do it, but IRAs do. So if you're old enough, if you're 59 and a half and over, you can be working or retired, you can move your money out of the TSP and do this. A lot of 401k plans, they don't let you do this. So you got to move it out into an IRA to do it. Now you can also contribute to a Roth. So whatever your contributions are, you can contribute to Roth TSP or Roth 401k, but those are limited. Most people, if you're closer to retirement, you've got a big balance. You need to do something with the big balance. Contributing to Roth is helpful, but it doesn't change the fact that you've got a very large traditional balance. And most people inside of the TSP, inside of 401ks, they don't usually let you fix that. That can be a problem. So the next risk is longevity risk. The risk that you last longer than your money does. The risk that you run out of money while you're still living. Now there are several ways that you can fix this. You know, if you earn more money and if you have more money, hopefully more of it's there to last you. You can get guaranteed annuities where you turn your money into a guaranteed check for the rest of your life. Now a lot of you may have a federal pension. Well, that's a payment that's going to last forever and it has cost of livings built in. You know, most everybody's going to have Social Security. There's a payment that lasts forever, has cost of living built in. But longevity risk is an issue. If you don't earn enough money, if your money does not grow enough, longevity risk can be a problem. Next, let's talk about interest rate risk. And this is the risk that a change in interest rates causes you to lose money. Well, let's think back to 2008. The stock market crashes. A lot of people move money to bonds to get out of the stock market. Interest rates were relatively high. The Federal Reserve kept lowering them. As you lower interest rates, it's really good for bonds. Bonds did amazing. But let's think about where we are now, 2022. Interest rates are pretty low. When you raise interest rates, if you're already holding bonds, that's bad for you. So a raise in interest rates means bonds are not doing so good. In 2021, the F fund was negative. Doesn't happen very often. I want to say it was 2013 maybe was the last time it was negative. Well, why is it negative? Because interest rate risk's been happening. They've been talking about raising rates. I think in 2022 they will start raising rates. That's what they say. Generally, bonds don't perform well when interest rates go up because of interest rate risk. So for people that have stock market money, they're getting nervous. They move a bunch of money to bonds. Yes, they got rid of the stock market risk, but they have introduced interest rate risk. So you can trade one problem for another problem if you're not careful. Now, are there conservative options out there that don't involve interest rate risk? There are. So you want to talk with somebody that understands your benefits, understands the tax code, investments, that can help you get this done. Here at Christy Capital Management, we would love to talk to you about these risks and others. So another risk is mortality risk, the risk that you die early. And so for a lot of married couples that we are working with, we run that scenario. What if one person dies early? Does the other person have enough money to make it to their 90s? And so how do you fix this if there's a problem? If we're doing a financial plan, it sounds bad, but let's say we kill off the husband, does the wife make it? And so one of the things you need to look at is the amount of money you have. One way to offset mortality risk is to have more money, grow more money. So maybe you have to be more aggressive to grow your money more, to have more, to offset mortality risk. Some people get life insurance. If I die early, I know I'm not going to have enough money. I better have some life insurance that kicks in. Maybe you've got a pension and you've got some survivor benefit options. You need to keep that in mind. When you're looking at your financial plan, you need to go through a bunch of scenarios. And one of them needs to be each spouse dies early. And we need to make sure that the remaining spouse still has enough money so we can offset that mortality risk. So the next risk is inflation risk. This is the risk that increasing prices, you got to pay more for everything. Your lifestyle now costs a lot more. It's the risk you run out of money because inflation went up. And so when you're looking at returns, one thing is to look at inflation adjusted returns. You know, that's one problem with federal employees and the TSP with the G fund is I think in 2021 it earned 1.4-ish%. The year before it earned 0.97. That's not keeping up with inflation. You'd have a negative inflation adjusted return. And so going too safe, getting too conservative, not earning enough, puts you at risk for inflation risk. One way to fix this is you got to have enough returns. Your returns need to be good enough, even above and beyond inflation, that you don't run out of money, or else the longevity risk comes back. One problem we talked about earlier, the longevity risk, meaning that you might outlive your money, people get a guaranteed payout annuity. Now the dilemma here is a lot of these products, you turn over some money, they give you $1,000 a month. Sounds good, but 20 years from now, it's still going to be $1,000 a month. And if inflation is pretty high, 20 years from now, $1,000 is not going to spend like it does today. So fixing longevity risk with an annuity, a guaranteed payout monthly check, puts you at risk for inflation risk. So all of these are interconnected. Every decision has an equal and opposite consequence. And so you need to know these things, put a plan together that has thought through all of these items. The next risk is sequence of returns risk. Now we all know that negative returns are coming, but it makes a difference when they come. So let's look at this example. You see here there's 5 years, and so there's a scenario A, a scenario B. The first year in scenario A, positive 25%. Year 2, positive 15. Year 3, positive 5. Then there's a negative 5 and a negative 20. Now in scenario B, all they did was reverse the returns. So the negative 20 is now in year 1, not year 5. So if you start with a $100,000 balance, at the end of 5 years, you're going to have $114,712 ending balance, average growth 2.78, both scenarios exactly the same. So in this case, it doesn't matter when the negative returns come, the average will be the same. But what if you're adding money? What difference would that make? Well, let's look. In this example, you're adding $10,000 a year every year. And so at the end of the 5 years in scenario A, you're going to have $159,000, average return 7.6. But look, in scenario B, you're going to have $182,000, you're averaging over 10%. Well, what's the difference? The difference is the sequence of returns. If you're adding money, it is better to have the negative returns early. It kind of lets you dollar cost average. You're buying some of it low, there's more of it there to have the good returns later. But what happens if you're taking money out? So here you're withdrawing $10,000 a year. Everything else is the same. Scenario A, after 5 years, you're going to have $70,000, which means the return minus 4.7. Now scenario B, you're only going to have $47,000 and you're going to be minus 12%. Well, what's up with that? When you have negative years early and you're taking money out, there is less money there to rebound when you have the better later years. And in retirement, this is the scenario most people are looking at. I'm going to be taking money out in retirement. Well, sequence of returns is important. If you have several bad years, back in the 2000, 2001, the dot-com crash, there were 3 years in a row where the stock market was negative. If you retire and have 3 negative years in a row and you're taking money out, your retirement is not going to look the same as if you retire and you have 3 or 4 really good years like we've been having. So there's a sequence of return risk that needs to be planned for. So most people are planning their own retirement strategies. And if you're not thinking about all of these risks, they can come back to bite you on the backside. You want to work with somebody that has strategies and processes in place that account for all of these. You know, maybe you can't handle a bunch of stock market risk. Well, there's other options to fix that don't cause the other risks, the inflation risk, the longevity risk. If you want help with these type of things, please reach out to christycapital.com. Call the number on your screen. We would love to talk to you about it. Till next time, I'm Mel Stubbs. We have to cut into this video to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We are going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You are going to want to work with someone personally that knows your situation personally, so seek out advice from an independent financial advisor. This is for educational purposes only.